Welcome back. Earlier today, durable goods, otherwise known as the M3 survey, was reported. The manufacturing, shipments, inventories, and order survey is created to provide a broad-based monthly statistical data on current economic conditions in the manufacturing sector. Specifically, when we talk about durable goods, we talk about those items that are designed to last more than 5 years, like appliances, computers, washing machines, automobiles, long-lasting items. Now, durable goods on a month-over-month basis down 5.4%. Durable goods excluding defense, which is a significant part of the durable goods orders, is down 6.7%. So the defense sector was actually the strong part of this report. In the middle, notice excluding transportation, basically flat on a month-over-month basis, up 1.3% year over year. So transportation was really the weak part of this report, defense, the strong part. Now we can see on a month-over-month basis, the yellow histogram bars show us the number, durable goods down 5.4%. This is the second lowest low, only preceded by July of this year. And before that, we have to go back several years to see a worse report. This certainly is a turn for the negative side in terms of durable goods. Durable goods excluding transportation. Now we know transportation has been the weak part, so this is flat, but flat is not really that good. We've had flat to moderately higher numbers, but really going back to June of last year, ironically, the beginning of the inverted bond market, we've seen just a lackluster report. Of course, transportation is an important segment, but there's a lot to do with durable goods not included in transportation, specifically home builders. When we think of durable goods, we think of appliances, washing machines. All of those are used in building new homes. If durable goods is bad, it speaks negatively to the housing market. Here we see durable goods excluding defense down over 6%. So if the headline number is down 5.4%, and then take away defense, it's down over 6%. It shows us defense is actually the strongest part of this report. Here, durable goods year over year, compared with the S&P 500 here in blue, clearly we can see as durable goods was strong back in 21, 22, S&P 500 was stronger as well. But as durable goods declined, so did the S&P 500. The curious question now is that as durable goods are basically flat again, where they were in February of this year, will the S&P 500 go back to February levels of 4,100? Well, we're above 45 at the moment, so certainly that's a cause for concern. Here's durable goods excluding transportation on a year-over-year basis. 3, 4, 5 reports barely in positive territory. We certainly saw a precipitous drop to the downside in 2021 and 2022, but since the beginning of the year, it has been lackluster at best. And again, this begs the question, if the stock market went down as durable goods declined, now that the stock market has moved back up to the 4,500 level, will durable goods go back to the upside, or is the stock market overvalued? Here's the durable goods excluding defense on a year over year basis. And this is actually in negative territory. You take away defense. This is the first negative report we've seen in quite a long time, as far back as 2021 at least. And this is one of the big numbers. Again, this is not something to be taken lightly. The durable goods order is one of the big numbers that the Federal Reserve watches when determining whether to raise lower interest rates or keep them the same. Certainly, this is not a vote in the positive direction. Now, the Fed funds futures already predict that the Federal Reserve is not, is not going to raise rates anymore. And the first rate cut with greater than a 50% chance is in May of this year. Maybe the odds will change as a result. Here, the red histogram bars show us the durable goods when those reports exceeded 5%, meaning when we had a very good report. We did have very good reports September of 2017 through September of 2018. Then we had a pause. Ironically, the stock market did not do very much. I know we did have this COVID correction, and then this rally subsequent to that correction was fueled largely by lower interest rates and a lot of spending. So this blip over here certainly doesn't, speak to the durable goods strength, which it was not. Then we saw durable goods reports exceeding 5% starting in October of 2020 in that area, and we moved up. Now it's sparing to say the least. Last month we had a good number, but again, it was just a blip. We've seen more durable goods orders negative of 5% or less than 5% than better. And that certainly does not speak well to the economy. And keep this in mind, keep this follows the existing home sales that we spoke about yesterday. That was also lackluster at best. It showed the slowest pace of home sales in about 13 years or so. Durable goods and home sales are very closely linked. When we buy a new home, when we renovate a new home, we buy long-term appliances, washing machines, things of that nature. If the home builder index is not good, we can't expect strength out of durable goods and vice versa. So today's report certainly does mirror what we saw yesterday in the existing home sales numbers. But we're going to keep a close eye on this and many other reports along the way. We hope this has been helpful. We look forward to seeing you back soon.